Here's the truth. If you have at least $500,000 in investable assets, there's a 76% chance you should be working with a financial advisor. But if you don't, the fees might be eating your returns alive. In this video, we're breaking down exactly when a financial advisor is worth it and when you're better off going solo. Let's start with the bottom line. What are you actually paying? According to NerdWallet's 2026 analysis, the median financial advisor charges about 1% of your assets under management annually. But that's not the full picture. When you add in investment fees and platform charges, the all-in cost averages 1.65% per year. Smart Asset data shows that 92% of advisors use an assets under management fee structure. And here's the good news. These fees often decrease as your portfolio grows. You might pay 1% on your first million, then 0.75% on the next million, and 0.50% on anything above that. So on a $500,000 portfolio, you're looking at roughly $8,250 per year in total advisor costs. That's significant money, which is exactly why we need to talk about whether you actually need one. Here's where the data gets really interesting. According to YouGov research from 2024, only 27% of Americans work with financial advisors. But break that down by wealth level, and the picture changes dramatically. Gallup data shows that 54% of upper-income adults use advisors versus just 20% of lower-income adults. The real inflection point? According to Wealth Tender's analysis, 76% of people with at least $500,000 in investable assets work with a financial advisor. That's not a coincidence, it's math. When you have that much money, advisor fees start to make sense because the value they provide can outpace what you're paying them. Below that threshold, you're essentially paying too much for guidance that might not move the needle. So what's driving that 76% adoption rate among wealthy clients? Wealth Tender's research found that 89% of wealthy Americans believe their advisor helped them grow wealth faster than they would have alone. That's a really high confidence level. Northwestern Mutual's 2024 Planning and Progress study added another compelling statistic. Americans who use financial advisor services expect to retire 2 years earlier than those who don't. Now, here's the important caveat. We can't say for certain whether that's because advisors are genuinely that good or because wealthy people who hire advisors were already disciplined and financially conscious. Selection bias is real, but the perception of value is undeniably high among people who can actually afford advisors. You have 3 paths here, and the costs are wildly different. A human advisor costs you 1.65% all in annually. Robo-Advisors, they typically charge 0.25% to 0.50% per year. And if you build a DIY portfolio of low-cost index funds, you might pay only 0.03% to 0.2% in fund expenses. On a $500,000 portfolio growing at 7% annually, that's $8,250 with a human advisor, around $1,500 with a robo-advisor, or under $500 managing it yourself. Over 30 years, those differences compound into hundreds of thousands of dollars in foregone returns. The trade-off is real, though. Human advisors provide tax optimization, behavioral coaching, and help with complex financial decisions. Robo-advisors give you low-cost diversification with minimal effort. And DIY investing requires discipline and financial knowledge, but it's the cheapest option. If you want the complete breakdown of when to hire an advisor, including a step-by-step decision framework, read the full article at the link in the description. And if you found this breakdown helpful, subscribe for more grounded personal finance content that cuts through the noise. We've got sources for everything in the description too.